Howdy there, folks. Welcome into today's video. It's a buy one, get two free for you here today. First video up here. This one's from 4 hours ago for this clip. Cyclical stocks are priced for a mild recession right now. Want to hear what Jeremy Siegel, the one professor, has to say in regards to this subject here today. Then our main man, Tom Lee, out here 5 hours ago on CNBC, talking about a few subjects. Thought I would react to that one, that little clip there, 3-minute clip, and then this last one, the 4-minute clip here. Lots of portfolios have too much tech exposure. I want to hear what these gentlemen have to say in regards to this. I think it's an important subject. So appreciate everybody joining me as always. Thanks for being here, folks. Thank you for being subscribed. We are approaching 30,000 subscribers now on this channel. So thank you so much, everybody that's here. And also, just so you guys know, I got a free workshop for you that's going to be pinned comment down there. I got one for if you make less than $100,000 a year, one if you make more than $100,000 a year investing in 2023 and beyond. Let's get into this
morning. So I guess you're suggesting, look, we're sitting on 13% gain in the S&P on a year-to-date basis, as everybody has remarked. It has been largely driven by a lot of the secular growth stocks that have gotten pretty excitable here. But you actually think the market is registering the likelihood of downside risk to the economy?
Yes, I do, Mike. You know, I sat on CNBC on January 2nd in the morning before the market opened, and I was asked, what do you think the market's going to do, S&P, this year? And I said 10 to 15%. I thought it was going to be the second half more than the first. And yes, total return.
Boom. You know who else thought, if anything, we were going to have a good second half of the year? Every other person on Wall Street, okay? Every single other person. Everybody was convinced going into this year the first half of the year was going to be bad. Stocks are going to be lower. You know, people were saying, why are you buying stocks in Q4 of 2022? It doesn't make sense. They're going to be lower in Q1, lower in Q2 of 23. And we got in the complete opposite, okay? Now, what is the important thing to keep in mind right now? The important thing to keep in mind is that's what they said, okay? Everybody was convinced the second half of the year was going to be good. Doesn't mean the second half of the year is going to be good, okay? It's a possibility we could have a flattish second half of the year. It's a possibility in terms of the NASDAQ and S&P 500 specifically I'm talking about. It's a possibility that it could go up just very, very slightly. It's a possibility it could go down. So just because everybody going into this year was saying, oh, you know, it's going to be a great second half of the year. They also said it was going to be a horrible first half of the year, and we got anything but that, okay? So just keep in mind, just because everybody was thinking that does not mean it's going to be, okay? So I think that's an important point that needs to be made.
It's been 14.2 to date. Interestingly enough, you take the Russell 2000 or you take almost any value index, and it's been 4%. You know, as we said, I think basically the cyclical stocks are priced for a mild recession.
The Dow Jones Industrial Average going into today up less than 2% for a year. It was up 1 point something percent.
Right now. And again, I wouldn't be surprised if that happened. And I think as a result, we could get a lot of churn in the second half of this year. You know, silly me thinking, oh, it's going to be the second half. And of course, market looks ahead. It turned out to be the 15% in the first half. But you know, it's hard to see a lot of upside catalysts for the market in the second half of this year. You know, we were talking, you know, you had Tom Lee on the show. You know, I've been saying that inflation basically with current indices has been dead really for 6-8 months, and they're just getting the residuals through on their official indexes, you know, that Powell is so concerned about. And I really think I think it's very likely we're not going to get those 2 increases by the end of the year.
Yeah, as even Powell has recognized, you know, keeping rates right here or maybe nudging them a little bit higher if inflation, in fact, is declining quickly, you know, the math says you're actually becoming more restrictive on monetary policy in real terms, right? So I guess the question is, do you think that
The professor there said he doesn't really see any catalyst for, you know, having the indexes go up in the back half this year. We'll discuss that in just a moment.
Mild recession is something that would disturb the markets, given the fact that we've kind of been living with this risk for a year and a half, at least. And as you say, if I look at the credit card issuers, you know, anything that's durable goods related, even the auto stocks, the traditional auto stocks, on a 2-year basis, they're down a lot still.
Right. Well, I think, the bright side of a mild recession is that not only will we not get rate increases, but I think there's still, and I've been saying this, even though everyone thinks, oh, there's no possibility that we would get rate decreases by the end of the year. So, yeah, they're not going to like, oh, yeah, there's going to be some softness in some of those earnings. They're going to like, I think, the
rate decreases are only coming if, let's be clear, okay, only if the economy weakens, quite a bit and you start seeing unemployment go up. Now, I want to attack the point he just made. He's talking about, I don't really see any catalysts for the back half of this year. I see several very important, massive catalysts for the back half of this year. That if these play out, obviously, we could have another nice run in the back half of this year. One catalyst is CPI actually coming in at 2s. It looks like we're likely going to be there within the next 1 to 2 months, potentially even this upcoming month. And so, being that we're likely going to be in the 2s, we're going to be where the Fed wants to stay. I think that's in itself a catalyst when we actually hit that 2 number and everybody's like, whoa, we're actually going to hit a 2? Like, oh my gosh, it's amazing, right? I think that's a potential catalyst. I think earnings for a lot of these big dog companies, I'm talking Amazon, I'm talking Meta, I'm talking PayPal, I'm talking NVIDIA. You're going to see their net incomes go off like a rocket ship in the back half of this year. I think that could potentially be a catalyst. There's a lot of stocks that are going to report some good numbers. I think the U.S. economy, based upon what I'm seeing out there, guys, I think the U.S. economy is a little stronger than a lot of people. I think, honestly, the U.S. economy right now is stronger than anybody thought it was going to be, including even myself. I don't think anybody thought the U.S. economy was going to be this strong. I went out there this weekend, restaurants just insanely packed. Couldn't even get into North Italia on Saturday night. Called at like 5 o'clock. They weren't even taking walk-ins because they had already been completely booked up. Couldn't even get into Topgolf. Topgolf was too busy. And this is like supposed to be the dead time of year out in Arizona where I'm at right now, right? And just like going to several different malls, like just busy, man. Everywhere is busy. Not the type of activity you see when you're in a recessionary scenario, I can tell you that. And so I'm like, geez, we're waiting on this recession and it's just like freaking everywhere is so packed. Like, are you kidding me? People are spending money, I can tell you that. But everybody's got a job. So, it's like, so that could be a potential catalyst if people start to give up more and more on the whole recessionary scenario. So nonetheless, folks, we have several different catalysts here that I think could potentially get us up if they kind of play out that way, right?
There's great consequences of this. A couple things. We all know jobless claims have not been looking good these last 3 months. Elevated. There are going to be 2 more before we get the June report. We're going to see the money supply report again tomorrow. It's going to be, I think, the 12th or 13th consecutive decline in liquidity and earnings. My feeling is, one thing I was thinking of, that blockbuster home builders housing starts data that we get. And everyone said, oh, yeah, the economy is so fine. But I think about this. Over the last 3 years, home prices have gone up nationwide 50%. Mortgage rates have almost tripled. So that means if you're financing with an 80% mortgage, the cost of home ownership has tripled over the period. And what has happened to real incomes over the last 3 years? Stagnant. So what I see is it's the biggest single component of consumer price index. If you're moving and don't have all that cash in your home, if you're a new home builder, you're not going to have all this cash for consumption, for trips, for cars, for everything else, which is keeping the economy going. So I'm looking at that. We're looking at the student loan payment restarting. We're looking at elevated jobless claims. And I'm not talking about disaster, but when people are saying, well, what is on that upside? I just don't see as many factors.
Yeah, he brings out a lot of good points there, and those are definitely some of the risks of the market in the back half of this year. And that's why, I'm kind of thinking we should go through some sort of nice pullback, correction, something here, because of all these worries about everything you just spoke about, cost of home ownership, obviously interest rates being still very elevated, and things like, student loan repayments starting, which, if you don't know, those are expected to start back up kind of around September, October. So if that's going to have a big negative effect on the economy, it will really play out more at the very end of Q4 and then obviously into 2024. So that's just something important to keep in mind. Alrighty, let's get into Fundstrat. Tom Lee, and hear what our favorite bull has to say.
Fundstrat, a global advisors, co-founder and a CNBC contributor, and we can talk Bitcoin, but that's not why you're here. In fact, I remember the time when I used to needle you at one point. I wasn't really needling you, but Bitcoin had dropped to about 4,000 from 20,000. And you were here, this well-respected equity analyst, and you said, yeah, I'm sticking with my 20,000 target on Bitcoin. And all of us would ask you, why are you getting involved in something so speculative that can hurt your reputation? Of course, it not only went from 4,000 back to 20, but it went to above 60,000.
Yeah.
So, I mean, kudos to you for just doing the work needed to understand that there might really be something to this, which a lot of people have not done to this day. Famous people haven't done. But I want to talk to you about stocks. You have not been that negative this year on equities either.
That's right. I think at the start of this year, a lot of folks thought we were going to have a hard landing and the Fed was going to really be tough on inflation. And we're now at the midpoint. Stocks are up 13%. The Fed's allowed markets to rise, financial conditions to ease, and it looks like we're slipping into an expansion. I think a lot of skeptical folks might be surprised, but, when you get to the mid-year and you're up over 10%, 9 out of 10 times you're going to finish the year even stronger. Maybe add another 12% in the second half.
Yeah, I mean, so the history...
That would be 25%.
The history of,
right?
Look, markets trend. And I also keep pointing out that the S&P is 10% lower than it was a year and a half ago, when I think nominal GDP is up 15% since then, and earnings are higher. So it's not as... Even though we get stuck in this mode of, wow, we're up a lot, we've traded higher under different circumstances.
Well, why did you say that the Fed has okay, so it hasn't tried to stop the stock market, but it hasn't been expansionary, has it?
No, the Fed's running tight monetary policy.
I mean, if I think about 12% potential upside S&P back half this year, that's like $500,000 to $1 million easy for me in the back half of this year. So I don't know, man. That's nice to think, but I don't want to get too confident about that whole prediction yet.
Last year at each of these FOMC press conferences, every time Powell was asked about how markets might be rallying, he got very uncomfortable. But as you know, in the last few meetings, when markets rallied on the FOMC rate decision, he didn't push back. And I think it's because inflation is going to set to track lower in the second half. I mean, half of inflation is housing, cars, and energy. It's 55% of the CPI basket. And we know housing's going to flatten out. Used cars are already rolling over, and energy's down. I mean, it would take a lot for everything else to keep inflation above 2.
Well, the narrative is that the pent-up demand for services and experiences with the millennials, that it's, there's not enough plane seats to go around. There's not enough tables at restaurants to go around. There's not enough workers to staff all these things. So they're going to keep asking for more wages. So that's the whole narrative, is that that's going to keep inflation high.
Yeah, I mean, it's been tough to see through, but those are beginning to cool on the wage side, and it's not as big a part of the overall CPI basket as people realize. It's roughly 25%. So, I mean, at this point, the Fed is trying to contain what could be more inflation from that little part of the basket. And if you look at the stock market, it's already kind of telling us inflation's set to cool pretty sharply.
So it's the bond market, isn't it?
And the bond market, yeah. In fact, I think people, when they look at valuation, because I heard some of your guests talk about it, excluding FANG, the market's at 15 times forward, which is really reasonable.
Yes. Reasonable. Certainly it would be reasonable if we were in an environment where interest rates were, let's say, in terms of Fed funds rate, we're at 1%, maybe less than 1%. But up here, I would call it pretty more fair. I would call it fair. That's a good way to put that. So overall, interesting comments out of Tom Lee. Kind of what I would expect out of Tom Lee, to be quite frank, and would expect nothing less. Next one up here. This one I'm really looking forward to.
that we've had this kind of a run over the first 6 months.
Without question.
What now? What now?
I think what now is you have to plan for the second half of the year, and you have to take a look at the calendar and understand some of the challenges that will be in front of you. I've said over and over again, the probability for a flat to negative quarter resides in Q3. But let's talk about what's going to happen here in the interim. You are going to have a significant rebalance for portfolio managers out of equities, which have in the quarter, S&P's up 6%, NASDAQ's up 12%, into taxable fixed income, high yield investment grade municipal bonds, basically flat. So that's what's in front of you right now. In fact, JP Morgan says that the overall selling in equities could be around $150 billion.
JPM's looking for a 5% pullback. They say there's a light catalyst calendar. The buyback bid is...
And you know what I say to that? I say, thank you. Get your flippin' flapjack and booty out of here, okay? I want these stocks for cheap, so please sell them. Please get the heck out of here, okay? And then you can buy them back from me for a lot more in a few years.
Beginning to decline due to the blackout period, which lasts for a while, and stocks are likely to fall as a result. 5% pullback seems the most likely outcome to them.
The rebalance is part of that. 5% correction, I could see it. 42.06 50-day moving average. Where are we in the S&P right now? 43.47, 41.19 100-day moving average, 39.94 200-day moving average. But let's remember something, Scott. You have to get past earnings. Earnings are the most important indicator for the remainder of the year. Sure. Not the Federal Reserve, not inflation, but earnings. Do you get the V-shaped recovery?
Well,
it's true. Earnings are in. What I think earnings are going to come in very, very strong for many companies. Not every company, but I think you're going to see margins and net incomes, EPSs surprise to the upside in quite a significant way.
Part of that goes to, and we'll get into it in a minute, Surratt, is because you've had so much multiple expansion with tech, you better have the earnings now to back up the multiple expansion that you've got. And I'll go through just how dramatic multiples have expanded through, especially mega cap tech. Goldman Sachs says the two most powerful tailwinds now for stocks are gone, being positioning, which was light, and sentiment, which was negative. So you've had money come in, right, from positioning, or at least money move around from, cyclical and value into growth. And that sentiment was so negative, now it's not so negative anymore. So you've lost two of the key catalysts as you enter the second half of the year. Make sense?
It makes total sense. And to your point of positioning, it's also rebalancing within the stocks, right? You're not just rebalancing out of equities into fixed income or treasuries. You're also balancing within what has become too big an exposure, right? Tech has become a really big exposure in a lot of people's portfolios.
That's a big question,
right? So are you going to look for other opportunities, and especially in front of earnings? Because if the multiples expanded so much, and you've seen that happen in some of these large cap stocks, where
I can tell you, people will look for other opportunities in rebalanced portfolios when, okay, and this is a big when they feel very confident that the economy is on solid footing and we're going to be okay. Until that happens, people like to hide out in a lot of these big techs because they're kind of seen as like, well, if there's upside, we're going to make upside here, right? If there's downside, it might be limited versus some of these other plays that might be a little riskier, right? And so if there's ever a moment where these folks get more confident, that's when you see major rotation starting to happen and saying, you know what, Apple doesn't have much ahead for upside, but we think this other stock over here. And that once again is going to come back to earnings and how earnings are looking and how guidance for companies are looking for the next quarter.
The opportunity, whether it's in healthcare, it's in defensives, it's in other areas, even some select utilities. So I think that's where you're going to see. So you get a double-edged sword, right? You get positioning, and you also get rebalancing.
The other thing, Anastasia, is that, time, it's been a while. Been a while since we've had a pullback. That's what Deutsche is talking about today. The last meaningful equity sell-off is now over 3 months ago, and a modest one, 3 to 5%, typically every 2 to 3 months, means a pullback is now arguably overdue. I mean, you can make the argument that stocks are overbought, a pullback is overdue. It really doesn't mean much unless, of course, you have the event that some are speculating that you might, and you do get a 3 to 5% pullback, whether it's Deutsche or JPM, calling for a similar sort of sell-off.
Yeah, I mean, Scott, I'm sympathetic to all those arguments about valuations, positioning, and sentiment. They're now getting stretched. And I think what we got last week, 1.5% pullback in the S&P and something like 4.5% pullback in semiconductors, I think that might be a start of something a little bit deeper. And just to drill down into positioning, for example, I mean, what's really driven this rally over the last 6 to 8 weeks has been everybody jumping in and trying to chase this market, trying to chase tech. You know, it's everybody from the systematic traders to hedge funds who have significantly added to their net longs. It's also the retail trading. And just look at the volatility, for example. The fact that call option volatility is as low as it is, that tells you that's been a significant amount of chasing. So I think that part, that chase, is starting to get exhausted. And then sentiment, more and more investors have gotten to be bullish.
Hey, why CNBC do that sometimes? They just cut people off, man. Anastasia was talking about all these points, and they just cut them off like that, okay? So overall, folks, we kind of got a market here in a little bit of no man's land, is the best way I can put it. We're kind of waiting for, give us the next thing to go off of in this market, right? We need the next CPI. We need earnings to come out. Earnings aren't coming out until mid-July to late July. So we've got a few weeks here where, like I've been stating on the main channel, we're just going to be all over the place, and that's kind of the way it's going to be. My hope is we pull back over this next few weeks, get some good buying opportunities going into earnings season. Earnings come in pretty respectable or really good guidances, and oh boy, okay, then we start to fly again. So appreciate everybody joining me as always. Thanks so much, folks. Thanks for being subscribed. On the path to 30,000 subscribers now on this channel. We're getting pretty darn close. So appreciate you being here. Also get your free resource. That is the pinned comment down there. Investing in 2023 and beyond. I got one for if you make less than $100,000 a year, and one if you make more than $100,000 a year. Much love and have a great day.